Hello guys, welcome back to my channel. For those who are new here, consider subscribing to my channel and also like this video, share it with like-minded Forex traders. Comment down below your thoughts, what you would like me to share with you or teach in the future. So today we have something very important that you need to know concerning your Forex journey. I realized that most traders, such as myself when I was just a beginner, do not have a Forex trading plan. You must have a plan. You must develop your own system, your trading plan that has an edge in the market. If you haven't developed a plan yet, it's very important for you to have a trading plan. If you do not have a trading plan, this is probably why you are losing money in the market, because you are not consistent with what you have planned to do. So I have prepared something more like a template or a paradigm which you can use to develop your own trading plan that works best for you, depending on what kind of trader you are. Everyone is different. So I would like you to watch this video till the end and make sure you follow step by step what I do, so that you can create your own plan. You can take the idea and create your own plan that works best for you. In 2025, you are going to be profitable if you develop a trading plan. Without a trading plan, you are just planning to fail. That is for sure. If you do not have a trading plan, you are planning to fail in journey. So let's look at the first things first. We are going to look at in our trading plan. Now I am giving you my own trading plan, which I developed as a day trader. I'm mostly a day trader, so I'll give you my own experience of day trading. Okay, and a plan which I developed. A plan consists of your strategies which you use. It consists of when you trade. It consists of what time frame you are trading on, or what time frame you are doing your technical analysis, and what time frame you are executing. So we are going to look at all that. So in my own plan which I developed, okay, over the years, which has helped me, okay, to be where I am today. In your own trading experience, you can break this down and develop your own trading plan. I'm just giving you a template. All right, choose first of all the assets that you're going to trade. All right, you are not going to be trading everything out there as a Forex trader. You're not going to trade all exotic pairs. You're not going to trade all the major pairs. You're not going to trade everything. You know, you have to develop an edge with particular pairs, Forex pairs that you're trading, or if you're trading some indices, you're going to develop some edge to trade those particular indices. Okay, so you have to choose the assets that you're going to trade, and you have to backtest all of them. Okay, those particular ones you have chosen, you have to backtest them and demonstrate that you can actually be profitable on the demo account first before you can go to a live account. All right, and trade your live account. So be sure that you backtest at least 100 times each pair on a demo and see that you have an edge or profitability, okay, in that particular pair before you can put it in the category of those kind of assets that you're going to trade in the real market with your real funds. All right, so be careful how you choose. Don't just get excited just because someone is trading GBP USD. You're also going to trade GBP USD without actually backtesting and knowing what kind of how does the GBP USD behave, the behavior, the characteristics. Every pair has the way it behaves. The volatility is different. All right, because gold is very volatile compared to pairs like GBP JPY or whichever other pair. All right, so you have to compare and see which one suits you best, or which one you are more familiar, or which one you have gotten used to trade, and which one you have understood best, and which strategies work with which kind of asset. All right, so you don't just trade anything out there. So the first thing is choose the asset you want to trade. So let's say, for example, you have woken up in the morning and it is a trading day. You have planned to trade a particular pair, say GBP USD. All right, what's the first? So you have chosen the asset you're going to trade that day. So we are now beginning to plan our day. We are planning our day, our trading day. Or let's say if you are a long-term trader, you are planning your week or your month, all right, or your full year. All right, there are those position traders who hold trades for the whole year. So we're going to be looking at that. So the second thing, after you've chosen your asset you're going to trade, okay, the second thing you are looking at is to do the top-down analysis. Guys, this is very important. Do your top-down analysis. The top-down analysis, which means you begin from the top, depend on a higher time frame to the lowest time frame, which you are going to actually execute, where you're actually going to execute your trades. All right. So first, you are going to analyze the market from a higher time frame. All right. So from that higher time frame, it depends. Higher time frame here depends on what type of trader you are. You may be a position trader, so your higher time frame of technical analysis may start from 6 months. Okay, and your execution may be even on a monthly time frame. There are people who enter and their entry time is 1 month, and they're going to hold that trade for 6 months plus. All right, so those are position traders who hold trades for a long time. So their higher time frame of analysis could be 6 months. 5 to 6 months or even above. All right. So they are holding trades for months at a time. All right. So they are also swing traders. Their technical analysis may begin from a higher time frame of 1 month. Okay. And their entry time could be four hours entry time. So there are also day traders such as myself, where their technical analysis may begin from a daily or 4-hour time frame down to a 15 minutes entry time frame. All right. And there are also those who are scalpers. Scalpers are those who are in and out of the market in the shortest period of time, maximum 15 minutes, and they're out of the market. So their higher time frame for scalpers could be 15 minutes. They're analyzing at 15 minutes and they're entering in 1 minute time frame. They are in and out of the market. They take their profit or their loss and they're out. All right. So your higher time frame of technical analysis depends on what kind of trader you are. So you plan based on which kind of trader you are. If you're a scalper, you're not going to start from a monthly time frame. No, you are in and out of the market the shortest period of time. So the general trend may not necessarily affect you because you are in and out in 15 minutes. All right. So you have to know what kind of trader you are before you can analyze the market technically. All right, so after the top-down analysis, and I'm going to be demonstrating to you how to do that, how I do that personally, okay? I'm just going to choose one asset at the end of this video to show you how I do my top-down technical analysis to the time or to the point of entry. I'm going to be showing you that. Also, the next thing you are going to do when you are doing your top-down analysis, you first of all determine the overall market structure or the trend. Market structure is basically, is it bullish or bearish? All right, so the trend. So you determine the overall trend on a higher time frame. Okay. In this case, if you're a day trader like myself, now you are determining whether it's a bullish trend on a daily or 4-hour time frame or a bearish trend on a daily or 4-hour time frame. That's what you're doing. So after determining the overall market structure, you mark out your areas of value still on a higher time frame, on a 4-hour time frame. I'm now talking about a person who is a day trader. You mark out your areas of value. What do I mean by areas of value? Pivot areas, where you have support and resistance, and also those resistance areas, or major resistance and major support areas, you mark them out clearly and refine them. Don't complicate things. Find where the price could not break above several times, and also mark out the areas where the price was not able to break below several times. Those are areas of value, support and resistance. All right, so still on a 4-hour time frame. And then you come down to a 1-hour time frame. That's why it's called top down. Now you are coming down after determining your structure. Okay, you mark out your areas of value, support, resistance. Okay, in some cases you mark out also trend lines at that level. Then you come to your 1-hour time frame and you refine your areas of value. Refine them. There are those smaller areas of value. You also mark them out on a 1-hour time frame. And refine your trend lines also. Okay, mark out trend lines and refine them. Find and identify chart patterns, if there is any chart pattern on a 1-hour time frame. What do I mean by chart patterns? Chart patterns like triangles, okay, bullish flags, bearish flags, pennants, okay, bearish pennants, bullish pennants, double top, or head and shoulder, inverse head and shoulder, such kind of chart patterns. You mark those out. Okay, and make sure there is a marking also of change of character. If there's any change of character, you have to identify and mark out necklines. For example, if you have like a head and shoulder, okay, you want to mark out if there's a change of character and the neckline has been broken and the market is reversing, or the price is reversing to the downside, or if it is an inverse head and shoulder, it is reversing to the upside. You want to mark out the neckline areas so that you can see them on lower time frames to determine how you will enter the market. All right. So now it is important to mark out if there is any reversal, which is why I pointed out change of character. If there is any change of character, okay, that goes against the major trend from the 4-hour time frame. So after doing that on a 1-hour time frame, now you go to the 15 minutes time frame for your entry. Okay, so you can see from the daily and 4-hour, we are down now to a 15 minutes time frame, and we have marked out all our areas of resistance. We have marked out all our areas of support. We have marked out all we have identified our chart patterns, which inform us which direction the market may be going. All right, and we have marked out our necklines, if any. We have marked out our trend lines. We have refined our support and resistance areas. Now we are ready to enter the market based on what, if there is a change of character. Okay, if it was on a higher time frame, it is bullish, and a change of character has happened, okay, with maybe a chart pattern like a head and shoulder, and the neckline has been broken. We are waiting on a 15 minutes time frame for a retest of the neckline before we can place ourselves on a very lower time frame, 15 minutes time frame. All right, so that's what we are looking at. On a 15 minutes time frame, we're looking at confluence to enter the market. Okay, and in that 15 minutes time frame, we're also looking at the smallest details of candlestick patterns like bearish engulfing, bullish engulfing, double top, and double bottom. We're also looking at triple top, triple bottom, things, candlestick patterns on the lower time frame that indicate that are in confluence with all the other tools that we have used. Okay, so if we have determined there's a change of character, it means the market structure is changing either from bullish to bearish or bearish to bullish. So we are trading in that direction. You are considering to follow the trend, as they always say that the trend is your friend. Follow the higher time trend. Okay, you don't want to trade against the current. All right, so now you go to your 15 minutes time frame, you look for entries, okay, using candlestick confirmations, okay, to buy or sell. So that is the plan you have. This is the trading plan you have to follow. And before you enter the market, there are other things you have to consider, which brings us to the next thing. All right, risk management. Risk management. So before you execute, check for high impact news that may affect that particular asset that you are trading. If it is Euro USD, for example, GBP USD, all right, and you see that there's high impact news that is coming that may affect the dollar, okay, you might want to adjust your risk or avoid trading at all. There are also instances where you have to avoid trading at all, especially if your capital is very small or your account balance is small. You want to avoid high impact news if your account is still small, $100 to about $500. That's a very small account. You want to avoid high impact news trading, all right? Unless you have a backup plan and you are willing to lose all that money. In most cases, that money is blown away. So you have to manage risk. Now we're looking at risk management here. So avoiding trading during high impact news, that is also part of risk management. You are managing your money, you are managing your finances. You don't want to lose it all. So you avoid trading during those times, especially if you have low capital, all right, or small balance on your account, all right? So before you execute, check the news, all right? So here you have done all your technical analysis. You are ready to enter the market, but you first check the news because you might enter the market when there is high impact news that may disrupt your technical analysis or your strategy. All right, so the second thing you want to do is mark out your stop loss and target your stop loss target safely beyond the pullback zones. You know, place your stop loss targets safely beyond the pullback points safely. All right, if you haven't watched my video on how to place stop loss and take profit using ATR, you can watch that video. It's on here. You can just check it out. All right, so I teach how you can actually use the ATR indicator to safely place your stop loss and also your take profit. All right, so when you place your stop loss, put it in a safe place beyond the pullback zones. And also the take profit targets should also be within the areas of value. Okay, the areas of value, the previous areas of value. You must, your target profit, your target should be at least to 1 to 2 or 1 to 3 risk to reward ratio. Don't be so excited and place 1 to 5, 1 to 7, 1 to 10 risk to reward ratio. Yes, it happens, okay? But if you are a day trader like myself, you want to target a 1 to 2 or 1 to 3 risk to reward ratio at most, all right? Okay, so if you're a swing trader, you can hold a little bit longer if you are sure that, if you are confident that the market is still going in your direction. You can trail stop loss, break even, or just hold the trade as you take partial profit in different positions. So that's very, very important, guys. Okay, so this is also, make sure it is a risk to reward ratio of 1 to 2 or 1 to 3 risk to reward ratio. Okay, that is part of risk. You are managing the risk. Let's say you are risking to lose $1, but if the trade went in your direction, you'd make $2. Okay, so risk to reward ratio is also very important. So calculate. The next thing you want to do is to calculate your position size relative to the account you have. So if you don't know how to calculate your position size, what is mostly known as a lot size, you can use so many free position size calculators out there in the internet. Most common one is Baby Pips position calculator. You can use that one to calculate your position size, okay? And use the appropriate lot size. Don't just jump in and use a lot size of 2 when you have a $100 account. It will be blown, especially if you are trading assets like gold. That account will not exist in the shortest time. All right, so we have also, after calculating position size, then you enter your position. When you enter your position, you have to wait patiently. Wait patiently because you have already calculated how much you are willing to lose, okay, without disrupting your life or disrupting your trading. So you have already placed when you place your position, or you open your position, or you enter the market, allow it to play out, allow price action to do its thing, all right? allow the market to play out and wait patiently for the results without emotion. And I'm not going to even say without emotion. Emotions are part of humanity. It's part of us. We are going to have emotions, all right? But you don't want emotions to control you or to dictate your next course of action, right? So the one way I'll give you some of the ways you can manage your emotions. Better you can do something else. Shut down the laptop, shut down the desktop, shut down your phone, all right? Or just close the charts. You have placed your trade. Whether you lose or win, you have already decided, but you have already managed your risk by placing the stop loss where it is appropriate, and you have placed your take profit at a point where you are willing to, how much you're willing to take, okay? So you just manage your risk. Some of the ways you can do that is by simply go to the gym, or play a game with friends, spend time with family, or read a book on finance or trading, all right? Develop your skill, read something else, okay? Or even watch a movie, go out into the fresh air, and just go about your day and just allow the market to do its thing. That is one way to manage emotions. But if you are always watching your phone and checking your phone and checking your laptop, you might end up closing that trade prematurely, okay? So the next thing you are going to do after it has hit your stop loss or hit your take profit, whatever the result is, the aftermath discipline. After that happens, if you have lost the trade, do not revenge trade. Revenge trading is basically when you start placing trades. Oh, you thought it was going down, but now the trend has changed to bullish, and then you begin chasing the price. When you start doing that, okay, to try to get your money which you lost, to get it back, you are most likely, in most cases, 99% of the time, you are going to lose even more. So do not revenge trade. Relax, all right? You have already lost that money, and that is what you were comfortable losing in the first place when you calculated your position sizing. You knew that you would lose X amount of money. So if you have lost, do not start chasing the market and placing random trades. That is called revenge trade. It's called over trading. So you begin over trading, putting so many trades more than you expected to trade. You thought you'd place one trade in a day, but now you are placing 4 or 5 trades. Also, if you have made the money that you had planned to make, for example, your target was $25 or $1,000 in a day. You have made that $1,000 in a day. However good the other opportunities are, please close that laptop, close that chat, and go. Take your profit and possibly reward yourself. Withdrawing, I don't know if you are withdrawing weekly or withdrawing bi-weekly, or you are withdrawing every month. So if you make sure you withdraw some of your profit and reward yourself with something that you always wanted to have. Buy new clothes, probably buy those new kicks that you like, or those new shoes that you like, buy a new car or whatever, move into a new apartment. Whatever you love to do, you have to reward yourself. That encourages you to get better, okay? So last but not least, be consistent and repeat everything that I've said from A to Z. Repeat it like scripture and adhere to it like scripture. Follow it strictly without deviating. If you do this, you are going to be profitable. So this is the plan that you ought to follow, okay? This is how I trade. This is how I trade every day when I'm going to execute a trade. These are the steps I follow. So it's called a trading plan. This is what you do. All right, so you can take this template, okay? You may not be a day trader like myself. You may be a position trader. You may be a scalper, all right? But you can take this template or this plan that I've shared with you here, and you can tailor make it to suit your own trading style if you're a scalper. All right, guys, with this example of USD JPY, we are going to analyze this from a top down, from the top to down, all right, to the entry point. So now this is the current situation we see. Previously it was an uptrend here, as we can see. Even when you draw a trend line here, you can see that was an uptrend, a clear uptrend, right? Okay, but then there was a change of character right here. All right, the price broke below here, below this trend line, changing the character, the market structure to a downtrend. All right, so now we are looking at a downtrend here. Okay, so the market dropped all the way to this support level. As you can see, we'll draw our support area here. You can see that previously the market tried to break below here, it could not, and now we see that a return to this area here, okay, and it bounced again back up. But the market has not cleared this point up here. There was this break below, and then the price returned to retest this breakout point here, okay? That's what we are seeing. a retest of that breakout point. So we draw our support, our resistance point over here. It's retesting this area. This previous breakout point is being retested. Okay, so that becomes a resistance area of value up there. All right, we'll change that to red. So now we have these two extremes. Okay, we have this support and we have that resistance. All right, so that is on a 4-hour time frame. So we can see this happened. Okay, we can remove this trend line. Okay, so we focus on what is happening now. There is another trend line you could draw here. We can draw a trend line there. Okay, so you can see a touch, at least 3 touches on that trend line. So we can see that this is what is forming here on a higher time frame. So you can see here there is a level here which has been broken. All right, signifying a change of character right there. You can see the price broke below there. And we shall be refining this line in our 1-hour time frame. So that is where we are at. You can see a head and shoulder pattern forming. All right, so let's go to the 1 hour. It's a neckline of a head and shoulder pattern. You can see a head and shoulder pattern right here. This is the left shoulder. That is the head. That is the right shoulder. This is the right shoulder here. So you can see that there is a head and shoulder pattern here. It doesn't have to be perfect, picture perfect, guys, for it to qualify. It does not have to be picture perfect. Okay, so this is a head and shoulder pattern on a 1 hour time frame. You can see there, and the neckline. Okay, this is the neckline here. The neckline was broken right here. Okay, where there is a trend line also from our 4-hour time frame. So there is confluence in this area. So this is an area of confluence. We can see why confluence, because there is that neckline which has been broken here, and there is also a trend line from our 4-hour time frame. All right, and there is this pattern here which is the head and shoulder pattern, which is a reversal pattern. Okay, it indicates reversal to the downside. Okay, so now what we are focusing on is selling, because the price has changed character by breaking below this previous swing low. There is a break below here, a break and retest, a break, and then there was that retest of that neckline plus the trend line from our 4-hour time frame was also retested, and then we saw that drop all the way to this position here. So what we are looking at is selling, because there has been a change of character at this neckline here. There is a reversal because of this pattern here, the head and shoulder pattern. So that's what we are looking at here. All right, so now we already determined that we are looking to sell at these areas. For example, in this 1 hour time frame, we can still mark this out, a small trend line there just to guide us. Okay, from these highs to there to the most recent. All right, and then we can go to our 15 minutes time, and we can also mark out this swing low right here. It's recent low right here. All right, so now when we go to our 15 minutes time frame to enter for a sell, already our trend line is marked out well from our 1 hour time frame. We are looking to sell. We are looking for a bounce off, like the market has already bounced off that area. Okay, there was this push up, then there is a bounce off that area. We are looking for price to clear this previous swing low. Okay, once this swing low is cleared here, all right, once this is cleared, we will be looking, once this is cleared, we will be looking for an opportunity to sell all the way here. Okay, and we will also be looking for a continuation down. If the price breaks below here, we will be looking for a continuation down here. to continue the trend. All right. So this is what we are focusing on right now. So this is what we are anticipating in this market right now. Okay. We are expecting it to drop even further down. All right. But should the price return and break above here, so you have to wait. You have to wait. You don't trade if the price breaks above these areas. Do not trade. So we are looking for confirmations here for a sell. All right. So we will place, should the price break below this point right now, we are going to look for a sell right here, and then we'll target these areas first. Okay. And then we'll push. Our stop loss will be just above these areas. Okay. Above this point. Our stop loss will be above there. Okay. To be safe, it should be above there. And then you can target a 1-to-2 risk to reward ratio. This is what you would target. You take partial profit here. Okay. Take partial profit here. If the price reaches here, you can move your stop loss to break even. Okay. You can move your stop loss to here and hold this trade all the way until it hits your 1-to-2 risk to reward ratio. Okay. Like as you can see right now, it's beginning to break below. So this would be a good sell position. So now this is how you would enter this trade on a lower time frame. You set your stop loss up there. This will be our stop loss. Okay. Up there. And this would be our take profit. Okay. Down here. 1-to-2 risk to reward ratio. Because we are anticipating that price will drop and take out this swing low to create a lower low. All right. Because it's a downtrend. We're expecting it to break below here to create a lower low. All right. So let's see what will happen. So you can monitor for yourself what would happen later on. Thank you very much for watching this video till the end. Consider subscribing and liking this video. Thank you very much. Bye.